when the Fed changes course and switches from wherever it's been to another zone, all hell breaks loose. The Fed has been at zero, the overnight cost of money, in a band of 0 to a quarter since late 2008. It's 6 years, 6.5 years and counting. In that 6.5 year interval, every forecast that the Fed has generated for the economy has underperformed. The global situation is one that we've never dealt with before, with pervasive deflation, most likely coming from the effects of IT, also coming from global trade, predatory patterns of global trade, principally in Germany and China. And we've never dealt with that before. Domestically, that we've never dealt with before is an unemployment rate that's now falling to the mid-5s, which in every preceding U.S. economic cycle has meant that wages are rising. And wages are rising while unemployment is falling. And instead wages aren't moving at all. Not at all. They're as close to dead flat as they get. Today we got a scary report that showed 295,000 new jobs. Average hourly earnings rose by 3 cents, 0.1%. That's no reason for the Fed to tighten, but the Fed doesn't intend to tighten. What it wants desperately is to get off zero, to rise above zero. Neither the Fed nor anybody in the markets knows what happens when the Fed begins to tighten, because for the Fed to have any interest rate at all is so yesterday, so back there 6, 7 years ago. So we don't know what it means. There are markers all over the financial markets that try to take the issues at hand out of the realm of opinion and put it into hard data. One of them, beginning about 2 months ago, the stock market began to go down whenever we got good economic news. The stock market's supposed to go up when we get good economic news. It's going down on good economic news because it thinks that good economic news means the Fed's going to raise interest rates. And so today was a very bad day. The stock market down almost 300 points at one point. Interest rates are right, mortgage rates are right back up. We're back up above 4%. We have, if anything, a fragile housing market. It's not going anywhere. It should be going somewhere, but it's not. And so mortgage rates back above 4%, back where they were before Christmas. Some of that is a counter reaction to a drop that was too big and too fast in January and early February. But up is still up, and up is not good for housing, not for fragile housing. But the way the cards are playing out, the Fed's coming in June. The Fed's going to raise the overnight cost of money from zero. Everybody's going to take a very deep breath between now and then and see what it means. Complicating life in the financial markets in the Fed's post-World War II history, which goes back now 70 years. Whenever the Fed starts to tighten, it never stops until there's a recession. We haven't heard the R word in a while. The Fed will try very hard to calibrate its rate increases to the actual strength of the economy. It is misleading in one respect, in that it continues to say that it intends to normalize policy. Now, we all think of normal interest rates as about 4% for the cost of money. That's 2% above the inflation rate, but we're not at 2% inflation, where inflation is falling. So maybe the Fed comes up above zero. Markets carom all over the place, trying to figure out where the Fed is going, while the Fed tries to figure out where it's going. If I've got a prescription, that's it, that we begin to bounce up and down, pretty good range, both interest rates and the stock market, until we in the Fed have a better understanding of what's taking place. There's a small chance, but it's real, that the economy is in the process of pinwheeling into the stratosphere. That it could take off very suddenly and at a very steep slope. And the Fed wants to take out insurance against that. But there's another chance that's at least as good, that premature tightening by the Fed can pull the plug on the economy just as fast. It's a high-risk time. And high risk is expressed in the financial markets in high volatility, and that's what we're going to get. Thank you very much.